Tonight's topic is going to be on market internals. We will talk about the 4 core market internals as well as some of the specifics in applying them to the markets. First things first, trading carries a high level of risk and you're subject to lose all or more of your original investment. Don't trade with money you can't afford to lose or money that, if lost, would affect your current lifestyle. The information in this presentation is for educational purposes only and is not intended to be financial advice. The purpose of the webinar is to help you better understand the markets and improve your skills as a trader. I really believe that a balanced life leads to a healthy life, and our attitudes really do influence our behavior. Trading is a small but meaningful part of the bigger picture. So let's jump right in talking about market internals and some of the specifics behind what really is driving the market. So we have 4 core indicators, if you will. Now, these indicators aren't the typical moving averages, stochastics, and chart indicators. What they are derived from are things like volume and the actual number of stocks that are in the NYSE and the NASDAQ. So we've talked about the NYSE tick in a couple prior webinars, and that's one of the 4 core market internals. Now, the market internals really act as a dashboard, if you will, or the gauges to the market. They kind of give us that under the hood perspective, if you will, and really help us dig down into whether a move is sustainable or whether a move has substance. So they act as a really good confirming or alarming indicator, if you will, to both confirm a move or to alarm you of the potential for reversals. So the 4 market internals are the breadth, the advanced decline line, the trend, and the tick. Now, these 4 market internals are specific to the New York Stock Exchange, and they're also available on the NASDAQ. So you can have 4 internals for the NYSE, and then these same 4 internals only using NASDAQ data. So I primarily just focus on the NYSE internals. I just look at the NYSE tick, but there is data out there for the NASDAQ as well. So if you're using thinkorswim, the symbols that you will use to get these data, for the NYSE, the breadth is just simply UVol minus DVol. So what that is the up volume minus the down volume. And the ticker symbol is $UVOL minus $DVOL. So in your charting platform, most platforms allow you to do a comparison, meaning you can put the minus sign in between, you can put the division sign in between using a backslash. With thinkorswim, you simply put it in just as on the screen here, $UVOL minus $DVOL, and that'll pull up the difference between the up volume and down volume, and we'll go in and break down a little bit more not only how the breadth is calculated, but then how it's applied. So for the NYSE advanced decline line, that's the relationship between advancing stocks and declining stocks. Same concept. In the ticker symbol box, using the thinkorswim charts, you can do $ADVN minus $DECN, and that'll give you the advanced decline line. The tick, as we've talked about, is just $TICK, and then the trend is $TRIN. And we'll get into a little bit more on the trend and why it's changing over at least the past 5 or 6 years. And then for the NASDAQ, the same concept applies, and all you do is add a /Q at the end of each symbol. So UVol/Q, DVol/Q gives you the breadth. Advanced decline, simply just adding the Q at the end will give you the NASDAQ data. So the tick, and then you can see the trend. So there's a couple different ways that I've looked at internals in the past, and the two main ways that I've set up my screen for absorbing this data and viewing the data, the first would be the chart view. And what you can do is, you'll see here in the upper left, I have got my UVol minus DVol as my ticker symbol. And then I just have it set up as a bar chart, and these are 15-minute bars, and that will give me the breadth on top. And you can simply use the little grid on the upper right to set 2x4. And then right below that I have the advanced decline line, the trend, and the tick. So I just set them all at 15-minute charts. On my tick, I have just a line here at 0 and then a line at plus and minus 1,000. We'll touch on the tick a little bit later. I won't go into as much depth on the tick specifically because I do have an entire webinar just devoted to the tick, but we'll go into some more specifics on that. And you can see it lines up really nicely, and you can just bump the window out and you have all your market internals data. Then the other way, as most of you know, or at least some of you have seen my post where I condensed my trading screen. And so what I did was I went from 3 monitors, and I wanted to challenge myself and see what I could remove, what I could take away from my trading screen and still have an effective means of trading. So what I did was condensed everything down, and instead of having this entire block of charts, I switched it to a numerical view. So now all I see are the numbers. So instead of having those grids, I have the NYSE and then the NASDAQ breadth here. And then I have, so this NBO is a NYSE breadth open. And then I have the current NYSE breadth right next to it, so I can compare what we opened at and then where we are right now. And then right next to that, I do have the NASDAQ breadth, and that's the open. Next to that, the current breadth. So again, I can see where we've been, where we've come from. And then next to that, I have the AD line, and then finally, I'm sorry, the AD ratio, and then the net number of advancers and decliners. So we'll get into the specifics on that next, but just to show you the two different ways to view those numbers. If you like having the chart on your screen, it makes it a little bit easier to see where you've been, where we have come from. So if you do have the chart view up, it's a little bit easier to pull back and see where we've been in the morning and kind of the progression that we've made throughout the day. The number view just makes it a little bit easier to condense things down. You get it all on one screen and kind of take away some of that distraction from having all of the other charts up. I do have a blog post specifically on this. If you search NYSE Tick on the blog, I have the code there, and I think that's also in the member dashboard. You can grab that code for Thinkorswim. So let's jump in and talk more about the breadth. So the breadth is a relationship of up volume and down volume. And again, that's just on the NYSE or just on the NASDAQ. So we're just looking at essentially one exchange, and the NYSE being the exchange in this example. So, you know, when we look at the markets in relationship to the market internals, we're only going to be looking at the U.S. indexes. So if you were trading the NQ, for instance, you'd want to be looking at the NASDAQ breadth and the NASDAQ internals. If you're trading the ES and the YM, then you want to be looking at the NYSE internals. So we'll stick with NYSE for now. And so what we have here is a relationship between the up volume and the down volume. And this results in a number that is typically between -10 to +10, and that's related to 1. So what that means is if breadth is 1 to 1, we have the same amount of volume flowing into up stocks as we do flowing into down stocks. If we have a number -10 to 1, we have 10 times as much volume flowing into down stocks as we do flowing into up stocks, and vice versa. If we have a number of positive 10 to 1, we have 10 times as much volume flowing into up stocks as we do down stocks. So those would be kind of the extremes, the plus and minus 10. And the breadth is really the king when it comes to the market internals. I place the most weight on the breadth. Now, the NYSE tick is the shortest term indicator because we're only really looking at the last tick of the NYSE tick, so to speak. The breadth is more of a slower, longer term, meaning we're looking at the bigger picture over the course of the day for the breadth. So whereas the NYSE tick, we're only looking at the last tick, the breadth, we're really paying attention to where we've come from and where we've been throughout the day. So that's a really good question you want to ask yourself. Where have we come from? And a really good way to go about learning the market internals and kind of absorbing their impact and maybe how they can help you and how you might be able to incorporate one, two, or all of them into your own trading is simply pull out a notebook or add a column to your trading journal and write down the market internals readings. I would do this starting at the NYSE open because you're only going to have data obviously from 8:30 to 3 Central Time. And I write down the breadth ratio at the open, and then I would do it for every 5 minutes for the first 15 minutes just to see how we've progressed. And then from there I just do it every half hour. And I would just jot down the market breadth, and then I would, be able to get a sense of, okay, well, we've opened at -3 to 1. So 3 times as much volume is flowing into down stocks as up stocks. Maybe that means we gap down. So regardless, if the breadth then at 8:45 is now -2 to 1, well, it's still negative, but we've improved from the open. And if at 9:30 we are now at 1 to 1, well, yes, we're at parity, but we've come from -3 to 1. So it's really interesting to see where we've been, where we've come from, and then where we are currently. So that's one kind of cool feature of that numeric way of looking at the markets. That code for the breadth open is pretty handy. A number outside of 3 to 1 is fairly strong. And let's see, Robert asks, would this also apply to the indices like the ES or CL? Definitely the ES. As far as the currencies and some of the commodities go, you can look to the market internals for a general gauge of market sentiment in the sense that if you're trading CL, if you're trading crude oil or gold or some other commodity, you may look to the S&P as kind of a gauge. You can look to the market internals as that same gauge, but I wouldn't necessarily relate strength in the NYSE breadth to an applicable trade in something like the euro or crude oil because they are fairly disconnected. There's really nothing that is tying them together except the fact that the data is coming from the New York Stock Exchange. So not directly, Robert. Now a number greater than 3 to 1 or -3 to 1 is fairly strong. And as I said before, a number of 1 to 1 would mean the market is at balance, it's at parity. Now, when we get these readings that are really extreme, such as we have a gap open, or a gap up or a gap down at the open, and we have some extreme reading like 10 to 1, or in some cases I've seen, numbers as high as 30 or 40 to 1, something that's, really bizarre, really out there, you don't want to fight those. And so when the market opens, it's important to look at where the market breadth is and how strong or how weak we are at that open. So you don't want to fight those. Typically days when we are 5, 6, 7, 8, 9, 10 to 1, those are the trending days. Days that are within, 1 to 1, 2 to 1, those are days that are range-bound days. So moving over to the advanced decline line, the advanced decline line is made up of the number of advancing stocks divided by the number of declining stocks. And actually, that's there's two advanced decline lines that that you can use, and you have the ratio and the net. So obviously, dividing would give you a ratio, and subtracting would give you a net number. So we're going to talk about the advanced decline line as one entity, but within that you have the advanced decline line ratio and the advanced decline line, the net sum. So just to kind of clarify, I hope that doesn't make it too confusing, but it gives you a resulting number between negative 2,500 and positive 2,500. So most data platforms pull on the NYSE around 3,000 stocks. So you get a handful of, close to that number between 25 and 3,000 stocks, 2,500 and 3,000 stocks. So you're going to get a net number resulting between 2,500 and positive 2,500. And then the advanced decline line is kind of the queen to the breadth. So we want to look at, is the advanced decline line moving in the same direction as the breadth? Is breadth getting stronger and the advanced decline line getting weaker? Are they both moving down? Are they both at extremes? So we want to use them in conjunction with each other to both confirm or cause alert us for possible things that may not be congruent to our view or a position that we may be in. So anything that's greater than 1,500, as we talked about with the breadth, anything that's greater than 3 to 1, on the advanced decline line, it's anything greater than 1,500 is very strong, both to the positive and negative side. If we get readings that are outside of 2,000, those are typically lined up with trending days. So if, for instance, we had an open where we may gap up and 30 minutes goes by and we're looking at the markets thinking about taking a trade, if we have a breadth reading of 6 to 1 positive and an advanced decline line of 2,000 positive, it would not be in our best interest to be looking to short in that situation because we have such a strong breadth reading and such a strong advanced decline line. So that can be one of those things that if you're on the fence about taking a trade, or for example you have two trade setups that may be presenting themselves, looking to the breadth, looking to the market internals can be a good way to gauge which setup to pass on and which trade setup to take. And whether you're taking whether you're using a halfway back methodology, whether you're using a low of high bar or breakout strategy, whichever method or strategy that you're using, it really doesn't matter. Market internals can apply to all sorts of strategies, and for the most part, any NYSE stock as well. Readings that are inside 400 are similar to NYSE breadth readings of 1 to 1. You want to use caution because it's kind of a range of parity. So there's really no one direction or one weight on either side. So now moving over to the trend, and this is a market internal that has since been shifting over the last couple years. So we'll go through it and then we'll talk about its relevance. The trend is a relationship of the number of advancing stocks divided by the number of declining stocks. So essentially, the advanced decline line ratio over the breadth ratio. So it's looking at the number of stocks and accounting for the volume in one indicator. So the resulting number of the trend is 0.5 to 3.0, and this is actually an inverse indicator, which means that a number below 1.0 is bullish and a number above 1.0 is bearish. The trend stands for the Traders Index, and it was developed by Richard Arms, so it's also called the Arms Index. But he did put together this relationship and came up with the instrument. So again, 1.0 is a market that's at parity, and we will sometimes see readings of more than 3.0, but typically 3 is the highest, and you really won't see anything lower than 5. Sometimes you'll get down to 0.25, 0.3, but very rarely does it happen. So Gary asks, what's the symbol for the TRIN? On Thinkorswim, it's $TRIN. And most platforms, if you do have some kind of search box, you should be able to pull up TRIN. It may be a slightly different ticker symbol, but it's probably derived of those letters, TRIN. It is losing as it's losing as its. Let me say that one more time. It's losing its effectiveness due to inverse ETFs. So the TRIN is encompassing the advancing stocks and declining stocks. Well, if you have an inverse ETF, it's advancing when the market's going down. So it's doing the opposite. So while the TRIN is an inverse indicator in itself, not to make this too confusing, after the introduction of inverse ETFs, it's began to kind of sway the TRIN in a non-effective way, because it's kind of influencing the volume inverse to the inverse, so to speak. John Carter does talk about the TRIN in his book, Mastering the Trade, and he does look at it on a daily time frame, and this is something that I would also do, that I have done in the past. I have since kind of stopped looking at the TRIN just because I haven't found it actionable for my intraday trading, so I just kind of passed on it. But as far as daily levels go, what John Carter would do is look at closes below 0.6. So each day, this is a great habit, and I used to do this for about 5 years. Is simply at the end of each day write down the close of the TRIN. So if we get a close below 0.6, John Carter says the market has an 80% chance of selling off the next day. And I did notice this according to his claims from the book, and just kind of piecing together my own thoughts from looking and observing the TRIN. So from a daily perspective, it did have some weight, but again, over the last couple of years, with the strength and the growing of the inverse ETFs, I've kind of lost some of its credibility. But if we get a close above 2.0, the market has an 80% chance of rallying the next day, and if the market can't rally, we could see a major sell-off. So just like the breadth, just like the NYSE tick and the advanced decline line, looking for those extremes, going through whether you keep a spreadsheet or a legal pad, and each night just jotting down the closing prices or the closing ratios. You may have nothing to see, or nothing that stands out for a few weeks, or even at times a couple months if volatility is really low and there's really not much going on. But it's when you get those spikes, those things that are out of the ordinary, as I'm sure a lot of you noticed, within your trading journals and things like that. Just like with your current trades, it's those moments that those trades that are out of the ordinary, where that can really make or break you, and it's those indications that are out of the ordinary that should send up a red flag and should be a cause for alarm. So I don't weigh as much on the TRIN, but I did want to get that in there because it is one of the 4 market internals. And then finally, we have the NYSE tick. And like I said, I did put together a full webinar on the tick, but we'll go through it here once again as well. So the tick is the net number of stocks upticking versus downticking. And not to be confused with tick charts, but the NYSE tick is an actual number that results in usually minus 1,200 to plus 1,200. Again, the extremes on the tick are what we're looking for. And a reading, I think the biggest reading I've seen is 1525. And rarely do you see extreme ticks outside of 1,200, both plus or minus. So we're looking for extremes, and again, ignoring readings within 400 because that usually is an indication of chop, and there's really not enough data in here in this number to give us any sense of bulls or bears winning or, you know, coming out ahead in a number of this caliber. So we're looking at the correlation between the high and low ticks and the price. So in my case, it's usually the price of the ES, and I'm looking to where do the high ticks line up at what time of the day with the price of the ES, and where do the low ticks line up with the price of the ES. So we're not looking to, you don't want to be buying in high ticks. You don't want to be buying when the market is looking for steam, when the market is potentially going to be losing steam, and you don't want to be selling when the market is potentially, you don't want to be selling in low ticks when the market is potentially losing its downward steam. And yeah, that's right, Gary. I do look for divergences in the tick. So I look at where do the high ticks line up, and do they line up with the high price? And if we get a high tick, and then after we get that high tick, if we get a new high price. So that would be a divergence. If we get a high tick, and then we get is followed by a high price, that's the potential for a trending day and to continue to make new highs. At the same time, if we get a low tick of, say, minus 1,100, and then we get a new low price, that could be an indication for a trending day to the downside. So when applying the market internals, you know, this is really kind of under the hood, so to speak, and we're looking at, you know, the sentiment versus the actual market conditions. So you have a lot of news feeds out there, you have a lot of headlines, you know, CNBC and all the talking heads kind of gauging and giving their sentiment and what they think and giving their opinions. And then you have the actual market conditions, what's actually going on with the volume in the markets, the actual, you know, stuff that the market is made up of. So this can help give us confirmation or alert us to, you know, potential cause for alarm. So looking for both converging numbers and looking at divergences. So again, is the advanced declining going up and the breadth going up at the same time, or are they diverging from one another, and how do they relate to both each other, the other market internals, and the ES, the Dow, the indices in themselves? So let's take a look at a few examples, and we'll go ahead and cover, I'll try to get to some of the other questions that I may have missed. So here I have broken down the breadth, the advanced decline line, and then the tick on the bottom left, and then the ES on the bottom right. So this is just a little 4-box grid. I actually got this from Peter Reznичek, or well, a similar version. I tweaked it a little bit, but he uses a similar grid like this. And I don't particularly use this specific grid in my trading, but it does make it easier. It does make it easier to compare all of them, all the internals, and view things for purposes tonight. You can see over here on the left on my tick chart I have the breadth ratio and the advanced decline line. So Thomas asks, what do I mean by a divergence? Well, perfect segue into our next example here. So looking at today's action, this is a 2-day chart. These are all 2-day charts, and we have them set to 15 minutes. So on the 15-minute chart on the breadth today, we had a steady decline, nothing too extreme. We closed the day at just under -2 to 1, and we spent most of the day in the negative, just about, I think we opened at -2 or so, and we chopped around at 1 to 1, and so we really didn't go anywhere, but we just kind of slightly drifted lower. Now if we move over to the advanced decline line, well, we did the exact opposite. We opened lower at about 1400 negative, and we slowly drifted higher all day. We really didn't do much, but what that is a divergence. Those two indicators or lines are diverging from each other. One's going down and one's going up. So now if we move down here to the ES, we can see, well, what did we do? We did nothing all day. We went sideways, and we had the breadth that was basically at parity, an advanced decline line that was diverging from the breadth, meaning we weren't getting weaker. So more volume was flowing into down stocks, but the number of stocks going down was actually decreasing. So if it was a really bearish day, if it was, for instance, a gap down with a breadth of -10 to 1 and an advanced decline line of -2000 that continued to move lower all day long, and the advanced decline line continued to move lower all day long, that is when you will see the ES simply go lower and lower and lower all day. And that's where you'll see the tick divergence, meaning you'll get a low tick of maybe -1000, and then the market will go ahead and make a new low. And then we'll get another low tick of -1050, and the market will make a new low. So you want to make sure not to be fighting those days. And if anything, if you only get one thing out of market internals, it's not to, I wouldn't say not to trade entirely, but use extreme caution when the internals are at 1 to 1, meaning the breadth is 1 to 1 and the advanced decline line is close to 0, within a couple hundred. That is extremely valuable in keeping from getting chopped up in a market that's going nowhere. For instance, today, a market that, in hindsight, well, yeah, it's obvious to see that we didn't go anywhere and we just chopped around in the range. But, throughout the day, as it's happening, it can be much harder to see as things are progressing. If we move back a day, so if we go to Friday, a little bit different scenario. We had the breadth move lower, and not extremely bearish, but moving lower, and we also had the advanced decline line moving lower, and we did have the ES moving lower as well. And then about half an hour through the day, 45 minutes or so went by, the breadth starts to improve, and at the same time we do get an improvement in the advanced decline line. And as those start to drift higher all day, or at least the breadth all day, the ES does start to move higher as well. Now, one thing to notice, as I was saying before, look at where we've been, where we have come from. On the breadth, you can see, without even incorporating numbers, we made new highs roughly 2/3 through the day, right over here, and we continued to new highs. We continued to get stronger. More volume was going into those up stocks. But then over here on the AD line, you can see we opened up and we moved lower, and we never actually did make new highs. Now the ES did just pierce its highs, but it did close back where it opened, kind of at parity, while the breadth was moving higher. So one of the things you can do, or you might want to incorporate to your nightly routine or nightly homework as an exercise, is you can pull up a daily chart. Here, I'll just do it right here. So pull up a 30-minute chart, and also, actually, let me do this. 15. I'm going to just move the breadth over here and make it bigger. Let's see if I can. That won't work. But what we want to do is a 30-minute chart of the breadth and a 30-minute chart of the ES, and I want to just make it a little bigger for you. There we go. Okay, that's what I'm looking to do. So we have the 30-minute chart of the breadth and the 30-minute chart of the ES just kind of overlapping each other. And we just want to kind of get a sense of, okay, where is the breadth making highs, where is the breadth making lows, and then where does the ES, the S&P, where does that relate? So one of the things that that stands out here is obviously this nice trend higher on the breadth back here on the 17th. And then we did have a nice trending day on the 17th as well, but we didn't close at highs. You see, this last hour of the day we did sell off, and that was followed by some range-bound action here. Again, this is a 30-minute chart, and this is encompassing 3 days of data here. And then if we look up here, we had the breadth strengthening a little bit, but then selling off. It really didn't do a whole lot. It certainly didn't come up here and break highs that we made back up here. And then consequently the ES didn't as well. We did have a little gap down here back on the 23rd, and we've been drifting higher ever since. Now, we were making new highs every day. New high, gap up, making a high, new high. We made a new high on Friday, and today we did not make a new high. Well, look what's happening. As the ES is making new highs, the breadth is actually not. So we had this gap up day here. Look at where the market gapped up, but the breadth is actually, it closed higher. Yeah, that's what I'm trying to say here. So the breadth closed higher, and the ES also closed higher, but then the following 3 days, the breadth closed lower. The breadth is making a downtrend. Going back to Thomas's question about the divergences, the breadth is making a move lower, making lower highs here, and the ES is making higher highs. So that is a sign for a potential reversal. So that's a divergence, meaning internally there's less volume going into the up stocks, and the ES is still moving higher. So the ES is essentially losing steam as we make these new highs. And if I flip back to a daily, actually, let's see, I want to go to internals, no, box. If I pull up the ES on a daily chart and I flip it to, well, that'll be all right. So this is trading hours only data. You'll see that the ES has been moving higher, but we have started to just briefly pull back. And if you're looking at the at a 50% retracement, or looking for an opportunity to get into a long position, say you see a double bottom here, and you're saying, well, I want to get into this move higher. We've broken the prior swing highs, and I want to get into the move. Well, buying up here at highs when the breadth is decreasing may not be your best opportunity. You would want to wait for the market to pull back a little bit, and we'll just say 1375, kind of that halfway point. Let the market come back and then jump on board. So just keeping an eye on the market breadth and where we've been, both in the current day, whether you're looking at the 5 or 15-minute chart, just getting a gauge of where the market breadth has been throughout the day, and then where have we been over the course of a few days, and then where has the ES been or the YM been, or if you're looking at the NASDAQ, where has the NASDAQ been compared to the NASDAQ market internals. As for the tick, I'm really only looking at the tick on an intraday basis. So if I flip this, I go back to the box where I have 2 days worth of data on the 15-minute chart. I'm only looking at the tick as its most recent number, and I'm only looking at it in the sense of real time. So I don't really go back and look at prior data on the tick except for certain extremes. So for instance, on Friday we had one of those extreme high ticks at 1408, and the low tick was only minus 1,000. So one thing to do, or one exercise, would be to look at the high and the low of the NYSE tick each day and see both what the spread is and which way they're weighted. So on Friday, the high was just a little bit, we were just weighted a little bit more to the upside than we were to the downside. Today we were clearly parity. The low tick down here was about 950, and the high tick was also just over 900, 950 or so. So it was pretty balanced. Some days you will have a NYSE tick where most of the ticks are up here near the 600 level, and the low tick of the day is only minus 200. So again, just kind of tying everything into one another, both as an internal indicator and then looking at the markets as well. And what is the price action that's going on in the markets? How is that relating to the market internals? So are they diverging? Are they congruent to one another? Those are the two main things to look for. And then watching out for a market that's at parity, a market that's at 1-to-1. So there's really a lot that can be said from looking at market internals. And as I mentioned before, I learned a lot of this market internals data and information from a guy named Peter Rezenchek. And there's a lot that can be said from just having a 15-minute chart with no indicators, with the exception of looking at these types of indicators. My trading screen is really full of nothing but a few lines and the NYSE tick. So I do have my indices as far as quotes go, but I really keep a pretty clean trading screen, and as it appears right now is actually fairly dirty in my eyes. So if I flip it over to the 15-minute chart and I get rid of the morning's high and low that I have marked here, on the ES sitting in a halfway back long, on the Euro sandwiched between a bigger halfway back long. We then came up and traded in a short, and then we bounced off another smaller halfway back long. So I kind of keep my screen just tuned in to my methodology, just tuned in to the halfway back. I have the 15-minute charts, and then I have my NYSE tick, and then my little breadth indicators and advanced decline line indicators as well. Curious why the 512 tick chart, why these little boxes here won't show up when you switch to a tick chart. And I'm not exactly sure why that is. It has to be something with the way the data is being pulled. But I noticed that too. If you're on a 15-minute chart or some type of time chart and you install these little boxes on your chart up here, they'll show up. But if you put them on a tick chart, they don't always work, at least in Thinkorswim. So that's why I just moved it over to the NYSE tick chart. I don't know a whole lot about the programming behind it. I did do a little bit of tweaking, or actually a lot of tweaking, to kind of modify these. The basis is from, I'm pretty sure it's from a ThinkScriptor code, and then I just inputted all the NYSE data and kind of tweaked it that way. But yeah, that's why I moved it over to the NYSE tick chart, because they won't show up on the tick charts on my chart. So not to confuse everyone too much. But that's the basic gist of market internals. You have your 4 market internals: the breadth, the advanced decline line, the trend, which again I don't look at that much anymore, and then the NYSE tick. So I hope that was helpful. I know there's a lot of information on the NYSE tick, but I did encompass that in another webinar. So you have the 4 market internals in this one, and the NYSE tick webinar separate. So I think I'm going to leave it at that for this evening. Again, just touching on the general setups in the market right now. We're in the long on the ES, but we do have the potential of coming all the way halfway back. So down here at 1378 or so. The euro has been a whole bunch of nothing lately, and the VIX being so low hasn't helped at all either. Rob asks where you can find the NYSE tick webinar. If you log into the member dashboard, so when you log in on the E-mini Mind page to get to the webinar here, all of the archive webinars are listed. And it was 2 or 3 weeks ago I touched on the NYSE tick, or maybe it was last week. And you can find it. You can find it in there, as well as a whole host of other webinars. So I think I touched on just about all of the questions here. I appreciate everyone for tuning in tonight, and I hope you found that helpful. And we will talk to everyone again next week. So thanks so much, everyone, and enjoy the rest of your day.